Waste Management stock is up 4.57% in the past year, and year to date they're down 6.59%. Well, that's actually pretty good when you compare it to the broader market as a whole during that same time frame, and that's really no surprise. We see investors a lot of the times during market downturns turn to really quality companies such as Coca-Cola or Waste Management, and that's no different for investors such as Bill Gates. Now, if we scroll down, we can see Bill Gates' current portfolio, Waste Management is actually his second largest holding. So this is obviously a really popular stock, despite what the current market is doing. But in this video, we're going to be jumping into my stock valuation spreadsheet to see if this company is a stock we should be buying or selling. And on the spreadsheet, we're going to look at 4 different valuation models. We're going to look at Graham's valuation, a discounted cash flow model, a multiples valuation, and a dividend discount model. And all 4 of these valuations will roll into our output tab. So let's go ahead and jump over here to our stock screener. If you'd like to be able to download this spreadsheet, then you can head over to my Patreon page at the link in the description. But the very first thing we're going to do is we're going to come up here and we're going to plug in the stock ticker for Waste Management and hit enter. And you can see all this data is going to automatically fill in. And there's a few things that we do want to look at real quick. Now, obviously, this is a dividend paying company. We can see they pay out $2.60 per share, current dividend yield of 1.71%. So kind of low, but they do have dividend growth, as we'll see later in the video. And the current payout ratio is currently sitting at about 52.1%. Now, a lot of times that's a lot higher than people typically like to see it, but for a more mature company such as this one, that's really not a red flag. That's the best way that they can provide value for their shareholders is by paying out dividends. Now, when we look at the moving averages, we can see the 20-day moving average up about 1.65%, but the 50 and 200-day moving average is down slightly, not a whole lot, at about 1 and 2%. Now, 1-year return out 5.83% and 2-year return at about 40%, currently trading at about $152 per share. Now, we're also looking at a 500-day chart here, but let's go ahead and zoom out a little bit more and say we want to look at a 2,000-day chart. And you can see this will load in. We've seen a huge run up over the past few years in the share price for this company. Now, analysts currently have a top price target of about $173 per share, but they also have a really low beta of about 0.78. So this isn't going to be a very volatile company. But let's go ahead and jump into our first valuation, which is going to be Graham's valuation. And this is a valuation model invented by Benjamin Graham. He wrote The Intelligent Investor, which is one of the greatest investing books of all time. And he was also a mentor to Warren Buffett. But this is the formula he laid out for us to calculate intrinsic value. So what we're going to do is we're going to take the earnings per share for this company. We're then going to multiply that by 7, which is the price to earnings of a company with no growth. We then apply our growth rate projection. Now, analysts and industry expectations are applying about 12 for a growth rate projection for this company. And then we add 1G, which is essentially the growth multiplier for this valuation formula. We then multiply it by 4.4, which is the average yield of AAA corporate bonds. And then we're going to divide it by Y, which is the current yield of AAA corporate bonds. Now, this got pretty high fairly recently at around 4.2, but as of now, it's a little bit lower than it has been in the past few months at 3.77. We can see after applying all of this into our formula, we come to an intrinsic value for this company of $100.45 per share, which is lower than the current price. But let's go ahead and look at our other valuation models and see how they turn out. The next one we're going to look at is our discounted cash flow model. And in order to perform a discounted cash flow analysis, we need to project a growth rate for the future free cash flows for this company. So what I've done is I plugged in all the prior years free cash flow for this company back to 2014. And this allows me to see the growth rate year over year for these free cash flows. We can see they have had a pretty consistent growth rate at about 12.01%. Now, I am applying a growth rate of about 13% after looking at analyst projections, obviously the past free cash flows and industry expectations. So I applied this 13% growth rate to the future free cash flows and applied it to the terminal value, which is the sum of all the future free cash flows past the year 2030. I then took the present value of these future free cash flows and added them together here. I then added the company's cash and cash equivalents, subtracted out their total debt to find their equity value, and then I divided by the number of shares outstanding, which gave me a discounted cash flow price per share of $166. So that's a lot higher than Graham's valuation, but let's go ahead and jump over to our multiples valuation. And the idea behind the multiples valuation is we should be able to value a company based on how the market is valuing companies that are similar in structure to that company using an earnings multiple such as price to earnings. So what we're doing is we're taking companies like RSG, WCN, and CLH. We're taking their stock price and dividing by the earnings per share to get the price to earnings multiple. We then take the average price to earnings multiple and multiply it by WM's earnings per share to get an intrinsic value of $143 per share. Now, when we look at these price to earnings multiple, we can see 2 of them are around 20, and then we do have an outlier at 30. If we jump back over to our stock screener, we can see that the price to earnings for Waste Management is currently sitting about 33, which is actually pretty close to the average price to earnings here. So we are going to get a stock price, or excuse me, an intrinsic value close to the current stock price for Waste Management. Now let's go ahead and look at our last valuation, which is the dividend discount model. And this valuation right here is going to be the reason a lot of dividend investors really love this company. What we're going to look at is, or this is going to provide us a valuation based on how much they pay out in dividends and how much that dividend payout is growing. So we're currently looking at quarterly payouts right here, which I plugged in so I can see how much they pay out every single year in dividends. And this allows me to see how much they're growing their dividends percent-wise year over year. We can see I've had a few years where it's been over 10%, which is absolutely phenomenal. Then a couple years here where it was at 6% and 5.5%. But overall, we have an average growth rate of about 8.78% over the past few years. So obviously this company has a commitment to increasing the amount they pay out in dividends. So I am applying a pretty high growth rate for this company moving forward of about 7% dividend growth. After applying a discount rate of 8.5, we can see we came to a dividend discount model intrinsic value of $185 per share. Now, anytime we do have a higher growth rate, we do want to jump back over to our stock screener, and I did mention it earlier, but we want to look at that payout ratio. Payout ratio is a little bit higher than I typically like, but considering the type of industry they're in and how long this company's been around, I really don't think this is much of a red flag. I think this is a very safe dividend moving forward. Let's go ahead and look at the last thing, which is going to be our output tab, where we can see all 4 of our valuation models put together. Grams at $100 per share, multiples at 143, discounted cash flow at 166, and dividend discount model at 185. When we average all 4 of these together, we can see we come to an intrinsic value of $148 per share, which is higher than lower than the current price of 152. But let's say we wanted to apply a margin of safety at 20%. We can see based off of this, our acceptable buy price would be $119 per share for this company. Now, obviously, this company has really strong discounted cash flow valuation and dividend discount model. So I think this is a really quality company, really strong. Obviously, like I mentioned earlier, people are going to love this company just because of the dividend growth alone. I think that is a pretty solid argument to consider investing into this company. But I think when we have times of market downturn, like I did mention earlier, we're going to see companies like such as this and Coca-Cola that are just really strong dividend paying companies. They're going to gather more attention from a lot of investors, and sometimes that will inflate the price of these companies past their intrinsic value. And I think that's kind of what we're seeing here right now. Intrinsic value of about 148, but the current price at 152. So I really love this company and just the overall structure of the company and how great of earnings they do have. But I think at current prices, it's not something that I'm currently considering buying. I'd love to see it go a little bit lower so I could add this quality company to my portfolio, but as for now, it's just on my watch list. But go ahead and let me know what you think of this company in the comments below. If you'd like to be able to download the spreadsheet, then you can head over to my Patreon page at the link in the description. So that being said, thank you guys so much for watching this video, and please don't forget to like and subscribe to the channel.